Hello everyone and welcome to the first of a three-part series on the Irish ELTIF. My name is Brian Kelleher and I'm a partner in the Dillon Eustace Asset Management and Investment Funds team. I am joined today by my colleague Cillian Breeden, a partner in that team. By way of background, since the introduction of the ELTIF regulation in 2015, take-up of the ELTIF has been hampered by complex and restrictive rules, particularly relating to portfolio composition and distribution. The revamp of the ELTIF regulation, known as ELTIF 2.0, came into effect earlier this year and is expected to generate growing interest from asset managers seeking to use the ELTIF as a go-to vehicle for investment into infrastructure, real estate and SME financing, at a time when there is growing appetite for private assets from both institutional and retail investors. From its part, the Central Bank of Ireland now permits ELTIFs to be established using legal structures subject to Irish investment funds legislation. The Irish ELTIF, therefore, is fully regulated EU alternative investment fund, which is authorised and subject to regulation and ongoing supervision by the Central Bank. In our next episode, we will focus on the eligible investment universe of the ELTIF. However, it is worth noting at this point that the ELTIF must have a minimum of 55% of its capital in long-term investments in the real economy. The remaining assets must be invested in UCITS-eligible investments. Today, however, our focus is on providing listeners with an overview of some of the other key features of the Irish ELTIF, including the liquidity profile. So, Cillian, if I can turn to you and ask you maybe firstly, for the benefit of our listeners, to outline the different legal structures that could be used to house an Irish ELTIF.
Thanks, Brian. Sure. So the Central Bank has confirmed that an Irish ELTIF can be housed within any of the existing Irish legal structures. So that will include the ICAV, the PLC, the ILP or Investment Limited Partnership, the Unit Trust, the Common Contractual Fund or CCF. However, subject to certain specific investor preferences, we expect that the vast majority of ELTIFs will be housed in either ICAVs or ILPs.
And staying with that theme of structuring, is it possible for an Irish ELTIF to be established using an umbrella structure?
So yes, the Central Bank rules allow for the establishment of umbrella ELTIFs. This means that once the ELTIF is established as an umbrella fund, more than one sub-fund can be established within the structure without having to create a new legal structure for each fund, for example. So this allows managers to house a range of sub-funds implementing different investment strategies or catering for different investor types within the same legal structure, which in turn means lower establishment costs as well as increased speed to market. Separate investment managers can be appointed to the different sub-funds within the umbrella, and it's also important to note that under Irish investment funds legislation, segregated liability exists between sub-funds of an umbrella structure. Finally, I suppose it's worth mentioning that the Central Bank has confirmed in its 8th rulebook that it is possible to establish a new ELTIF within an existing QUAIF umbrella structure.
So moving on to the operation of the ELTIF, who are the principal service providers and parties that are appointed to an ELTIF?
So firstly, an ELTIF, regardless of where it's established in the EU, must appoint an EU authorised AIFM to act as its alternative investment fund manager. In practice, those promoters considering establishing an ELTIF can either, firstly, appoint an EU AIFM from within their own group, which, if it's established outside of Ireland, can passport into Ireland, or two, appoint a third-party independent AIFM, which is unrelated to the promoter. Secondly, all EU ELTIFs must entrust their assets to a depository for safekeeping. The depository will also be required to perform cash monitoring and oversight functions. It's worth noting that Irish real assets depository regime does, however, offer a depot-light alternative, which is available to closed-ended funds marketing only to professional investors, which generally invest in asset classes such as infrastructure, real estate and private companies. While the investment management function and administration function can also be discharged by the Irish AIFM, in most cases we would expect a separate investment manager and administrator to be appointed by the AIFM to perform these functions. In both cases, any such delegate would need to be approved or cleared by the Central Bank in advance to provide those services to an Irish domiciled ELTIF. If the ELTIF is established as an ICAV, it will have to appoint a board of directors, each of whom will need to be pre-approved by the Central Bank and will be subject to the Central Bank's fitness and probity regime as well as the individual conduct rules. If it's structured as an ILP, The general partner, which must appoint the EU AIFM, doesn't need to be authorised by the central bank or any other competent authority. However, the central bank must be satisfied as to the general partner's competence and probity. The directors and partners of the general partner are also subject to the central bank's fitness and probity regime and the individual conduct rules as well.
Thanks, Cillian. Tax is an important feature as part of any fund structuring. What is the domestic tax treatment applicable to Irish ELTIFs?
Sure. So as I mentioned earlier, the Irish domiciled ELTIF will be authorised under the existing Irish investment funds legislation. So as a result, the tax regime will be determined by the legal structure in which it's chosen to house the ELTIF. This means that an Irish ELTIF will be subject to favourable tax regime that currently applies to an Irish regulated fund established as either an ICAV, an ILP, a PLC, a CCF or unit trust. So therefore an Irish ELTIF will not be subject to any Irish tax on incomes or gains that it may realise from its investments.
One topical question currently is whether the Irish ELTIF can avail of the fast track process, which is currently availed of by the Irish QAIF. And as you know, under that, the Irish QAIF can be authorised within a 24-hour period of the central bank having cleared all relevant parties. Do we have certainty in relation to the central bank approval process for Irish ELTIFs?
Yes, Brian, so we do have certainty on that, and the central bank has confirmed that where an ELTIF is to be marketed to qualifying investors or professional clients, it can avail of the central bank's 24-hour approval process. In that case, as you say, provided all the relevant service providers and where relevant directors of the ELTIF have already been cleared by the central bank. If the application was submitted, for example, before 5 p.m. on a Thursday, we would expect to receive the authorisation of the ELTIF before close of business the following day, being the Friday. If the relevant ELTIF is being marketed to retail investors, then the central bank will require the prospectus of the ELTIF to be submitted for review in advance, and it's not until that is cleared before it will allow the application for the authorisation of the ELTIF to proceed.
What type of liquidity profile can we typically expect in an ELTIF?
So given the nature of the assets in which an ELTIF invests, they're typically structured as closed-ended funds, meaning that investors have no ability to redeem their shares during the life of the ELTIF. However, it is worth noting that the ELTIF regulation does contemplate the possibility of establishing an ELTIF which does provide investors with the right to redeem their shares during the life of the ELTIF, subject to certain conditions being satisfied. So those include, for example, the imposition of a minimum holding period and an obligation to ensure that redemptions are limited to the percentage of the UCITS eligible assets that are held by the ELTIF. However, just to bear in mind that as mandated under the ELTIF regulation, ESMA is currently working with the European Commission to finalise delegated acts which will set down more details in relation to, I suppose, requirements that will apply to open-ended ELTIFs which offer liquidity.
We've touched on some of the key features of the Irish ELTIF, including the liquidity profile. As a general question, why choose Ireland as a fund domicile for the revamped ELTIF product?
Sure. So I think that there are a number of reasons why Ireland is so attractive to asset managers considering the establishment of an ELTIF. So firstly, I think Ireland offers a fully regulated ELTIF product with a very open and engaged regulator, which is focused on implementing the ELTIF regulation in a robust but effective manner without gold-plating any of the requirements set out in the ELTIF regulation. So that's a big positive. The quality, responsiveness and expertise of Irish-based administrators, depositories, auditors and lawyers in funds investing in long-term assets, as well as the fact that Ireland is an English-speaking common law jurisdiction, have also been, I suppose, identified as key drivers for choosing Ireland as a domicile for your Irish ELTIF product. As I mentioned, from a domestic tax treatment perspective, ELTIFs will not be subject to income tax or capital gains tax, nor will they attract any subscription tax, which is charged in other jurisdictions. I think that the ability to establish the ELTIF as within an existing QAIF umbrella is also proving to be a big draw to those who have already established a QAIF umbrella in Ireland, as this I suppose offers the ability to market your fund as an ELTIF product without having to establish a new ELTIF structure and incur the costs and time and consequences of that.
Thank you, Cillian. And thank you everyone for joining us. We hope you found the Q&A session helpful, please visit our website to access the other 2 episodes in our series on the Irish ELTIF. From Cillian and I, bye for now.